In this video, we're going to be talking about the 3 types of candles that can occur from one bar to the next. And once you know those, you will understand what a reversal or continuation looks like because there is only so many of them, which means we know exactly when things are reversing and exactly when things are going to continue. Let's get into it. Before we do, there's supposed to be a PDF for this, but it did get wiped. So sadly, I'm going to have to remake it. And they take me a very long time to make. I believe that one took me about like 5 to 7 hours. So I'm going to try and get these videos out as soon as possible. And me doing that is going to mean we're doing it from the charts and from that previous image here, which we're going to get into. That also being said, the second thing, there's going to be some overlap between this video and the previous one, but it is still important. There's still new content. Pay attention, and I promise you we'll get to making trades in the very near future. After the next video, you'll understand how to at least look for things to move, and then risk management comes towards the end of all this information, so you know what stuff's doing. So bear with me. There's a lot of videos to make, so let's get into it. The first bar, the inside bar. So we mentioned it last video, but again, there's going to be overlap. It's the last time I'll say that. So the inside bar is a lower high and higher low to the previous range. So you're going to see there is no new highs or lows being formed to this candle here. That is an inside bar. When we're talking about inside bars, the bar prior is called the mother bar, which will be referenced more in future videos. So keep that in mind. And the inside bar, if it is still open, meaning this candle is still trading, we call it presently inside or still inside because we know at any point this could turn into a 2. And what is a 2? A 2 is a trending move. Before we get to that, once this closes, we call it an equilibrium. And the reason we call it that is because since it's made no new highs or lows, buyers and sellers are agreeing on prices here. And once you have closed that, price must attempt either side of this range. Doesn't mean it will be a successful breakout, but it does mean it has to at least attempt to. Now, when it breaks, we get a 2. In this case, a 2 to the downside. Why is that? Because we have a lower high and a lower low to the previous range. And it doesn't matter if this is green, it would still be a 2 down. It could be bright green. As long as it's lower high, lower low, it's still a 2 down. And the reason that is because by definition, this is trending lower. Lower high, lower low. Very simple. And on the upside, we can have a 2 up, where we get higher low to the previous candle's low here, and higher high to the previous candle's high here. That is by definition an uptrend. And then the third candlestick. What is it? The 3, the outside bar. And what a 3 is where you make higher highs and lower lows to the previous range. And it's an incredibly important thing to know about because it tells us a ton of information about how price action works. So first, a 3 on a lower time frame is a broadening formation. What is that? A broadening formation is a series of higher highs and lower lows. And since it's a series, we know they'll make lower lows and higher highs over and over again. So that's important to know. What the 3 also tells us is that price takes out both sides of the range. And that's one of the 3 things it can do. It can either inside bar consolidate, the 1, 2, trend, or 3, take out both sides. And what that allows us to do is gauge magnitude, which simply means the other side of the range. So when we're looking at this, since a 3 is a broadening formation, we can draw it off of the 3 right there. You can see slight lower lows here to this stuff and this stuff, so we include both. And then higher highs to that, so we include both. And since it's a broadening formation, it broadens over time. So once this candle closes, the range has gotten bigger. Once this one closes here, the range has gotten bigger again. And then you can see they consolidate and then trend upwards. So how do we gauge the magnitude of that? Well, we look for the other side of the range to take this high out. And you can see we actually go right to the line. Why does that happen? That is because support and resistance is not horizontal. It's not flat. Although we can use these as flat lines, saying if we make new highs and come back in, we're going to try and take the other side out. What we understand as stratters is since the 3 is a broadening formation, we know over time price broadens, the range gets bigger, which means horizontal lines do not account for time. And that's the one thing a lot of people miss. They don't account for time. And that's what the strat does so well, which we'll talk a lot more about time and time frame continuity in the next video and the following videos of that. But we can then see we take out the highs, and then it fails those highs by coming back below them. Then we get 2's trending to the downside. So we're going to go and do what? Take out both sides of the range. And when we say that, we would say these bars here are all an outside bar of everything left of those within the broadening formation. So from here to here, you'll see this is outside of all of that. That is what the try is. That's what a broadening formation is telling us. It's telling us that this 3 has now gotten bigger. We have this 3 here, that's way bigger. And then this one got even bigger again. So what happens if we reverse and go back through? It's like, we're going to try and take that out. And then you can see, since over time they broaden and they occur in a series of higher highs and lower lows, you make new highs and then new lows. And you can see they get really big. And this is what a lot of traders also fail to see. And the reason they do is because, and you can see to the penny, pretty nice. The reason they don't see this, or I guess what would you call it? The symptom of not seeing this is when you make a little, and then lose a ton. And what normally happens is you have wide stops because you don't want to be wrong. And you might get in here and be like, well, it's going to go up. It's like, okay, it goes up. Then you make money. It's like, awesome. Then you get in here. It's like, well, maybe I'll short it. It's went up. It's like, it's probably going to come back down. It's like, you short in here. It's like, awesome. Make some money. And then you get long again. You're just like, well, now it's bull flagging. It's like, what are we going to do? We're going to break out of the consolidation. And you can see they pop it up to get those people to try and get in there, right? And then since you have wide stops and you don't really know where stuff's going, you lose a lot because the range just got way bigger. And then once it does that, you might chase it short and then you get blown out the other way. It's like big problems. And then they'll do it over and over. And that's why it works, because once it makes new highs, everyone's like, I want to buy the breakout. Once it makes new lows, it's like, I'm going to sell short because it just broke out to the downside. That should now be resistance. And the problem with that is we know support and resistance is not horizontal. It broadens because over time, broadening formations get bigger and price trades in a series of broadening formations, as you can see here. And this is utilities. So a lot of cool stuff happening in utilities the past couple months, or I guess couple weeks. So now that you know 1's, 2's, and 3's, you know price can either 1, inside bar consolidation, 2, trend going in one direction, or 3, take out both sides of the range. And the 3 tells us then we can gauge where price is going, because if we fail these highs up here, we're going to aim for these lows so we can go outside bar of the previous range, taking out both sides. So now that you know that, we can talk about reversals. So this sheet, I highly suggest printing it out, and perfect. You guys can print it right from here, take a screenshot. And if you don't know how to do that, if you're on Windows, you can Windows key and type in snipping tool and click the new snip, and you can go and screenshot it and print it off. You should have this printed off on your desk, behind your computer, on the wall, sleep with it, put it under your pillow. You need to know this stuff. So now let's talk about it. The inside bar, 212 bearish reversal. We get the 2 to the upside, going up, inside, so equilibrium gets formed, and then they attempt it to the downside here. And our target is to take out the low of that 2. Why is that our magnitude, or why is that our target? Because that's the other side of the range. That's one side of the range. Because we made a new high and new low here. Or actually, we made a new high, and we have a higher low. Then we go inside, so we're not doing anything. Then once it breaks, we look to make the new low here. And since we know the broadening formation, we know if that were to fail, they would go and try and take out the other side of this too, to take out both sides of the range, which is the rev strat, which we'll get to. So 212 down, target is the low of the 2. 212 up, target is the high of the 2. And you might be like, Alex, these magnitudes are so small. You can do this on a yearly time frame, so they are not small. Trust me. Now, we also have the 2-2 bearish reversal, where we get a 2 trending to the upside, and then a 2 in the other direction. So if you bought in here, you're forced to sell because once you're under here, anyone that bought there, they're in a losing position. The magnitude of that is to go these bars outside of this. So once you hit your target, you have made higher high and lower low to the previous range. That is a compound 3. We have a lot of names for the broadening formation. We call it a broadening formation, a 3, compound 3, a try. They all mean the same thing. It means you've taken out one or both sides of the range. Now, 2-2 bullish. You can see the 2 to the downside, countered by the 2 up. So trending down, now boom, trending up. These 2 bars go outside of this. Then we get the 3-2-2s. The importance of this is you have a 3, which is what? A broadening formation, because it has taken out both sides of the range. So on a lower time frame, this is a series of higher highs and lower lows. Just got really big and created the 3. Then we get the 2 up that fails, starts coming back in. And then the 2-2 reversal, targeting the other side of the broadening formation, because then these 2 bars go outside of this bar, completing the try, hitting magnitude. Then vice versa on the upside. And these are repetitive, and they should be, because if you're going to be trading this stuff, you want stuff that repeats, you want it to be simple, and you want it to be boring. So once you know this stuff, it's simple, boring, and repetitive. So let's keep going. The 3-1-2, another inside bar reversal. The 3 to the upside, inside bar coming back into the previous broadening formation. That then breaks the equilibrium to the downside, with our target being the low of the 3, because that's the other side of the range. That's the bottom of the broadening formation. Vice versa on the upside. Then the rev strat. And not many strategies have this, because this is a counter of the equilibrium break, which means it is a failed breakout. And if you've ever seen a chart pattern, you know they go like this. They're like, well, we look for it to go like this, get really tight, and then break higher like that. And then what happens if that fails? It's like, well, this is the failed pattern. It's like, what would that be? There's the inside bar, there's the 2 up, and then here's the 2 down right here. So most strategies don't have this. And that's why it's important, because the countering of an equilibrium tells you a lot. It tells you there was agreement on price. Buyers took it higher. So the buyers were more aggressive, meaning they're now in long positions. And since this bar went out up there, they can stay long if they want. Now, if it's coming back through on the next candle, anyone that bought in here has to sell. Anyone buying the lows in this consolidation, buying the double bottom or buying the liquidity run, they're going to have to sell. And then anyone that was long into this bar also has to sell under there. So you get 3 sets of pivots to go and take out. And the magnitude of that is to make the new low to this bar, because then these 2 go outside of that, and vice versa on the upside. Then we have the 3-2s. These have no magnitude. Why is that? Because the 3 is a broadening formation and it's going higher. Then we get the 2 down. So if you longed into that, it now gaps lower, took out the low of the 3, which means anyone in here, they're instantly at a loss, which means if you bought, you're going to have to sell. And since it's a 3, we know now the range is getting bigger. And if you haven't seen a 3-2, let me just quickly remind you guys what COVID looked like here. You get the 3 and everyone's like, whew, that was a really bad market crash. And then it's like, guess what? 3-2 under there and you're going to get really killed. Look at how far they drop. They go all the way down, $67 drop. And that happened in less than a month. And you can see if we zoom out, is price trading in a series of higher highs, lower lows, higher highs, and lower lows? It absolutely is. So definitely want to know about that. That being said, 3 to the upside and then 2 back down. No magnitude. So we look for these as an entry on like a gapper or something, but we'd also want these to have a higher time frame target to go after, which we'll talk a lot more about that stuff in future videos. Then vice versa to the upside. It's like you get really short, and then it takes that out. It's like you got to get out, and now we're expanding the 3 in the other direction. So it's like this is how you lose a little and then lose a lot when it goes the other way. So then we have the 1 bar bearish rev strat reversal. Since the 3 by itself is a reversal, the reason that is because a 3 must be a failed 2 first. So you go 2 up with this gap higher, and then it goes red, telling you it gapped up. So anyone that was long before, they got what they wanted. Now they're profit taking, or at least shorts are coming in. So once you get back under those previous highs, if you're long into this candle, you're going to have to start getting out because you're losing, right? And if you don't, you're going to lose a lot. So now we take out both sides. So we went from higher highs, higher lows, to now once we take out the low of this bar, we make lower low. That being said, the last one, after we'll get to continuations, the 222 bearish Randy Jackson. So what this is a successful pullback, because when we're looking at pullbacks, what it is a reversal up that gets countered to the downside if we're looking for a pullback to get short on, or reversal down to get countered to the upside for a pullback to get long on. And whenever someone's saying, I want to just buy it when it pulls back, if they're buying when it's going down, they're missing out. Like, you might be able to snag a low here and like, awesome, good for you. But if that keeps going, it just reversed, right? So like now it's going lower. We want it to be going up when we buy because we don't like holding losing positions. So we wait for that thing to reverse back up. And you'll see it's 2 to the downside, 2 to the downside, and then the 2-2 reversal right after that. And then the continuations. So the word measure to move is here. And what that means is we get a strong 2 to the downside, inside bar consolidation. And this would be like a bear flag on a lower time frame for those that trade that. And then the 2 to the downside again. And we look for the same size 2 to occur. That's how we measure the move. Because we know it's trending down. We know they had a brief pause, and we know it's trending down again. Then vice versa on the upside. So that's all that is. We'll talk a lot more about measured moves because there's a lot more to it than just that. But when we're looking at a 2-1-2 like that, that's exactly what we're looking for. There's just different ways we can use that idea. Going forward, we'll talk about it. Then the last one, the 2-2-2 bearish continuation. And then to the upside 2-2-2. And we look for these after one of our reversals works. So if we take that and it hits target, since we know the range gets bigger and we know it just reversed off the bottom of the range and now it's taking out the highs, if it's going to get bigger, it won't reverse. And if this bullish rev strat doesn't reverse, what's it going to do? Either 2-1-2 or 2-2-2. So what do we look for then? If we were to go, or actually we'll go, DXCM was a good example of this. And I've recorded this video a couple times, so that's why I've got the examples ready to go. Now, the 2 up, 2 down reversal. Notice you also have the actionable signal shooter. So that tells you that's a good thing to be looking at. And when we're talking about mother bars, what you can see is we are mother bar to this. And what happens when you do that is you create new broadening formation where you're going to make new highs and new lows because the series will restart. So we'll talk a lot more about that, but that's why we're looking specifically at this one and not at this one. Now, the 2-2 reversal hits its target. What do we look for? 2-2-2 continuation. Then you get 1 bar reversal against you. And you can see they're nowhere near taking that out. And then they reverse it down right again with the 1 bar reversal 3. And notice it's 3-3. So that's why it's important. If you're looking at a 3-2 reversal to the upside and that doesn't work right away and it goes red, you don't want to hold on to that because now it's potential 3 of the 3. So on a lower time frame, if you go to like a 15-minute, it's like, check this out. Goes all the way into the highs. You try to get that new high to go 3-2 and make the range bigger, and it fails right here. It's like, get the heck out of the way, right? And then you get 3-2. What happens after that? Expansion, 2-2-2. So this range started here and then got bigger, right? And how do you gauge magnitude? You go to the other side of the broadening formation. And then if they're really going to fall apart, you can see they get out of that try and then puke, right? And they'll retest that as well. That's what I wanted to cover in this video. As far as examples go, we can go back to AEP and what happened today? What was tradable today? 2-1-2 measured move. It's like, how do we measure that? From high to low, moves $2.14. So we'd project that out and say, well, this candle, we'd want it to see $2.14 range. Then it does $4. So we sometimes get more than we bargained for. Sometimes we get less. It depends on a lot of other factors, which we'll get into in the next videos. But that all being said, I'm going to end it off here. I know we went off the cuff. Everyone said, just wing it, Alex. We want another video. So I'm getting it out here. And I'd like to reiterate, the whole goal of this series is to have one place for people to go to learn the strat for free, well organized, in a manner that hopefully will make you guys not profitable. I can't guarantee that, but at least not losing traders. That's what we want to see. And as long as I'm doing that, that's what I set out to do. So I'll see you guys in the next one. And if you have any questions, once again, let me know. If you like the video, please like and share.
And how true is not enough.